Hello, everybody. Welcome to P.B.M Money. Today, I want to talk about something that most of the other personal financial people on the internet are not talking about. And I think it's because they haven't lived it. I've only seen the connection that they're trying to make happen one time in my life, and that was in the early 80s, just before the big boom. So I'm going to paint you two scenarios, and then we're going to follow the money and see what happens. Scenario number one. At some point, loans for real estate mortgage slow down. Alright? And it doesn't matter at what rate they slow down, how quickly, how slowly, how long. None of that matters. The fact of the matter is they pick a point in time and go through the next point in time. Let's say 5 years, is the sake of argument. And in that 5 years, the mortgage loan rates go down. Okay? Now, we just came out of an extended market of that happening. The loan rates went down to almost zero. I mean, they were zero for a long, long time. The banks were given stimulus money so that they could just, for zero. So they would go loan, and then they didn't. But, whatever. Okay, so if the loan mortgage numbers that are created every year go down, what does that do to the real estate market? And by the real estate market, I mean the buying, the selling, the building of homes and businesses and apartment buildings. How does it affect all of that if the number of mortgages made goes down? Well, if that goes down, that means that the housing market, the home ownership market, goes down. That means you have less homes available in any market to sell. Right? I mean, if the banks aren't going to make the money, or if the banks are not going to loan the money, so the money dries up, so the builders say, well, we can't make any money at that. What happens? They lay their workers off and go find a job. That means the purchases slow down. Let's take a look at that. Purchases of new homes means new and existing homes in any market. I mean, look at any market around you. When people talk about the housing market, you gotta ask them exactly what are you talking about. Are you talking about new homes that are being built? Are you talking about existing home ownership? I just bought three little rentals and all of them were built in the 1960s or 70s. So that doesn't get rid of those properties. They're talking about the new home mortgage rates. So as the rates go down, what else goes down? The prices go down. Because if there was money to be made in that type of a market, then people would be buying houses faster than they can be built, which means the price would go up. Which I did a recent video, and that was why I was so confused. I just went to look at a piece of property that was for sale, and had well over 100 people. It was a $200,000 home in the Midwest, which is 4 times the average for a piece of rental property here in the city. And I kept saying, where is all this money coming from? If the market is so, right now it's a seller's market, but is it? Is that being controlled? But if the number of loans go down, that means the number of houses for sale goes down, and that means the amount of house that you can buy for the same amount of dollar goes up. Because let's say you have a $100,000 home, and it appreciates every year 5 to 7%. And you've had it for 5 years. Now for the same amount of money, you can go get a 25% more home. But likewise, that means if somebody comes to buy your house, they're going to pay 25% less. But that's not what's happening here. The number of loans are evening out or slowing down, and yet the housing market has not loosened up. It's still a seller's market. But we've got our face too close to the plate of vegetables that we can pull back and look at the whole meal. And by that I mean, you give it enough time, you give it low enough rates, the housing market will come back. Because what will happen, even in this kind of a screwy market, the loan rates that the banks make will increase as the market breaks up and the prices go down. The reason the prices will go down is because the rates will be up. But that's a short-term thing. As soon as the supply is filled, then the housing will slow down a little bit, and that won't take long. And when that happens, the number of loans will come back down, and the amount of houses you can get will go back up. Now, I know that sounded complicated, and here's what I want to say for the rest of this video. When I'm talking about up and down and rates and numbers and all that, that's not the important part. The important part is what I'm about to tell you right now. So pay attention. No matter, when you hear these guys, mostly millennials, when you hear them talk about the housing market, what they are normally talking about is the new and existing market that banks are making loans on that are available in the market. How do I know that? Because of the scenario I just painted you. What happens to the rental market? It's red hot. We're living it right now. Real estate rates are up. Prices are up. And the market is on fire. Okay, let's talk about the opposite. If the opposite happens to the mortgage loans, okay? Number of mortgage loans made go down. Well, let's say they go up. The number of mortgage loans goes up. What happens to the housing lending market if the rates go up? Again, we're in that right now. The first little rental home I bought 2 years ago, I paid just over 2% interest for it. The last one I bought, which was a year, 6 months ago, I paid over 5. So the interest rates are definitely on the way up. Now, what is the increase in the interest rates going to do to the market overall? It's supposed to slow down sales. I just told you of a $200,000 property that came on the market. That means there's a lot of cash out there. People looking to dump cash somewhere. Okay, so the number of loan rates goes up. Loans speed up. That means prices should go up. If the loan rates are going up and the prices are still going up, that means that inflation is in play. And that's what's going on right here. The government is not allowing supply and demand to work out. Because if the mortgage loan rates are up, which they have doubled recently, then the housing market should be slowing down, and it's not. It's still hot. Now, it's true that it's only in certain segments of the market, but it's the mainline segments. Back in the 70s when I was in the market, an average house stayed on the market for an average amount of time, usually 3 to 6 months. If the average house is on the market here in Springfield in a certain ring, like that one I told you about, didn't last 3 days. Of $250 million house. But if you take inflation out of it, which I did in the first time that we looked at it, if the housing rates are going down then, and we don't have any inflation, then that should speed up the market. Or if the rates are going up like they are now, it should slow down the market. But it's not slowing down the market. It's still speeding up. And that's one of the major places where inflation is showing itself. It's just hiding very well because everything else is getting the press. And probably with good cause. Because when the housing market busted, and when I say busted, I mean busted, back in the 70s, it took a long time for the economy to bounce back from that. Because, if I can't remember, but I think the number was 1 in 12 or 1 in 18 jobs in this country relied on the housing market in one way or another. You know, through lumber or manufacturing or construction or trucking. But when that one hits rock bottom, we're in trouble. But right now, inflation is keeping that up. Now remember, we're talking about purchasing of new and existing homes and new construction of like malls and shopping centers and apartment buildings, all that stuff. If inflation is going on and you got a fistful of dollars to go buy a piece of property, what are you going to buy? Now, in the short term, you're going to go buy something that you can make a lot of money with right now. Well, it's not going to be the stock market. It's not going to be securities at all. The mutual funds and that, they're doing okay. But the individual investor, for the most part, are getting killed right now. So you're waiting. So if you're in this market and you've got inflation going on and you've got housing prices going up and you've got a seller's market, what are you going to do? You got nowhere to put your money. So now you got to wait until one of those markets busts. Now, when one of them busts, you're going to be in a great position. And let's hope it's not the housing market, because if that one is the first to bust, that means the interest rates have gotten really high, and when it busts, it's going to go down, not up, which means our problems are going to get worse, not better. That's why I think the easing is going to slow down or stop in the near future, and just hope that we can grow the market, the stock market, back. That's what I think should happen. That's what I hope happens. Because if they keep pushing this rate up, hoping to bust inflation, there's a 50-50 chance they don't bust inflation and they bust the housing market, and that's going to be, all bets are off then. But if they handle it the right way, this could turn out to be a great real estate market and a great stock market, and inflation kept in a moderate range. But if they're going to have to tippy-toe all the way around this thing, and it's their own fault because they've built it. But now let me ask you the same question in the scenario I just painted you versus the first one I painted you. What happens to the rental market if the current market continues to exist, which means it's a seller's market, interest rates keep going up, the amount of houses you can buy with your money continues to go down. What happens to the rental market? The answer is it continues to burn like fire, because that's what's happening. The rental market is on fire in both scenarios. So my question is, why aren't the investors going and buying rental real estate? Because if they did, me and all the other investors would be sunk, because that's where we put our money. And that's what made me do this video. I watch very closely to what the millennial people on the internet, when they who talk about finance, I watch very closely what they say and what they do. And right now they're talking about how bad the housing market is, and then they turn right around and talk about the $1 million homes they just bought. And I could give you a name, I could give you 10 names and you know every one of them are on there. And every one of them just got done buying a nice big piece of property. Well, there's a reason for that. They're going to get their property bought before they can talk the market down. Because now's the time to buy the property. The market is tight. Loan rates are high. But the value of the dollar is also high. So if you got $10 million sitting around, go put $1 million of your own money into a piece of property. And then when the mortgage rate turns around, they go sell it. That's what the big boys are doing, or renting it out. Graham Stephan went on a big buying binge the end of this year. And he's still going. He's in a real estate co-op buying properties all around the country. But yet on his program he's talking about the market's busting. Real estate market's going in the toilet, and he just keeps buying. I really dislike the disingenuousness of that. But it's not just him, they're all doing it. And I thought I should sit down and explain what the heck is really going on. They're talking about the home mortgage rates. I'm talking rental real estate rates. Well, that's all I wanted to talk about. You guys have a great day, a great week, and happy investing.